Welcome to The Explainer. Okay, today we're taking a really close look at what is arguably one of the most critical structural shifts happening in global logistics right now. Back on April 28th, 2026, UPS held an earnings call that honestly wasn't just your standard run-of-the-mill financial update. It was a bold declaration of a massive corporate restructuring. So we're going to unpack the immediate, pretty dramatic news from that Q1 2026 report and hopefully translate all that complex data into a clear, compelling story. Now, before we get completely lost in dense financial spreadsheets and, corporate strategy speak, let's just ground ourselves for a second in the physical reality of UPS. Because behind every single percentage point of margin and every $1 million in revenue, there are real people operating a vast, insanely complex network, moving literally millions of packages every single day. The financial decisions we're about to explore, they have a direct, tangible impact on those frontline operations. Okay, let's dive into this. Here is our roadmap for today's explainer. First up, inside Q1 2026 earnings. Then, the transformation strategy costs. Third, a decade of financials. Fourth, peaking in 2022. And finally, becoming fit to serve.
All right, kicking things off with Section 1, inside Q1 2026 earnings.
Look, every major transformation requires architects, right? Here we have Chief Executive Officer Carol B. Tomé, and alongside her, Chief Financial Officer Brian Dykes. These leaders aren't just, tweaking the margins here. They are making sweeping operational decisions to fundamentally alter the structural layers of the entire organization. Moving right along to Section 2, the transformation strategy costs. Bam! $55 million. Just let that number sink in for a second. This figure is the total pre-tax transformation strategy cost for Q1 of 2026 alone. Reimagining a century-old delivery giant absolutely does not come cheap, and management is basically eating a massive financial toll right out of the gate this quarter just to pay for it. Now, what's really interesting here is how that $55 million breaks down. A massive chunk of it, $31 million to be exact, is going straight into compensation and benefits tied to workforce reductions. That's up from $24 million the previous year. Once we factor in a $13 million in income tax benefit, the actual after-tax reality hitting the books is $42 million. They're spending incredibly heavily on severance and restructuring right now, basically to buy future efficiency. Which brings us to Section 3, a decade of financials. To understand why this is happening now, we have to look back. The story really kicks into high gear with that wild pandemic-era logistics boom. Back in 2020, UPS was pulling in a very healthy $84.6 billion. But as the world locked down and e-commerce just absolutely exploded, those numbers skyrocketed. By 2021, revenue jumped to $97.2 billion. And by 2022, they crested this massive historic peak of $100.3 billion. They were practically printing money as the entire world suddenly relied on home deliveries. But as we all know, booms eventually cool down, and the post-2022 reality was pretty sobering. Revenue slid down to $90.9 billion in 2023, held totally flat in 2024, and then fell even further to $88.6 billion by 2025. That nearly $12 billion drop? That perfectly explains the intense, almost frantic urgency behind management's current restructuring. Let's dig deeper into that drop in Section 4, peaking in 2022. The real severity of the situation becomes crystal clear when we compare profitability. At the absolute height of the boom in 2021, UPS was sitting on a very comfortable net margin of 13.2%. Fast forward to the end of 2025, that margin had literally been sliced in half, dropping all the way down to just 6.3%. It costs a massive amount of money to run a global logistics network, and when volume suddenly drops, those fixed costs will just eat your margins alive. And these tumbling metrics, they absolutely connect across the board. Check this out. Free cash flow completely plummeted from $10.8 billion down to just $4.7 billion. Return on assets dropped from nearly 20% to under 8%. And honestly, perhaps most shockingly, the return on invested capital fell from a massive 42.4% down to just 12.8%. These aren't just minor dips we're talking about. This is a fundamentally different financial environment than 2021. It made it undeniable that leadership absolutely had to reimagine their operational efficiency. So how are they fixing it? That is Section 5, becoming fit to serve. Now, if you actually read through the earnings report, you're going to see a phrase popping up a lot: fit to serve. Let me be your corporate translator for a minute.
When a huge company says this is an initiative to right-size the business and respond to market dynamics, what that basically means is they are cutting overhead. Specifically, they are aggressively reducing management headcount to protect the bottom line. It's a very direct response to those shrinking margins we were just analyzing.
Now, Fit to Serve actually piggybacks on another huge initiative called Transformation 2.0. This was a strategy they officially wrapped up in 2025. The main goal there was to modernize their tech and basically stop relying on clunky, expensive legacy systems. While that sounds super technical, it also meant paying out heavy third-party consulting fees and, pushing through earlier rounds of workforce adjustments. But it set the structural stage for the much leaner operation they are chasing right now. So this all builds into what is essentially a complete operational battle plan, right? They are aggressively right-sizing management. They've got outside consultants coming in to rethink their network. But honestly, the most fascinating operational maneuver here is that they are actively transitioning a portion of their ground saver volume over to the U.S. Postal Service for last-mile delivery. They're quite literally offloading their less profitable, high-effort residential deliveries to a partner just to save on their own operating costs. It's wild. At the end of the day, everything we've just unpacked, from that immediate $55 million hit in Q1, restructuring charges, to the historical nosedive in free cash flow, it perfectly illustrates a massive, iconic company actively and urgently tightening its belt. The pandemic created a historic boom, for sure, but the post-pandemic reality absolutely demands a leaner, much more agile organization. And for you and me, this behind-the-scenes corporate restructuring is exactly what ends up dictating shipping speeds, delivery costs, and ultimately, who actually drops that package at your front door. Which really just leaves us with one incredibly critical question to think about. Will these aggressive right-sizing strategies and deep management cuts actually be enough to protect UPS's bottom line in a totally post-pandemic economy? We've seen the battle plan, and we've definitely seen the costs. Now, the entire market is going to be watching to see if Fit to Serve can actually deliver the goods. Thank you so much for joining me for this explainer, and I highly recommend keeping a really close eye on their next earnings release to track exactly how this transformation unfolds.